Okay, thank you, ladies and gentlemen. Thank you very much. I hope you're all now comfortable. And in defiance of my very good friend John Brogden, who earlier accused me of working on a steam typewriter, which is only partly true, I've got an iPad. I'm digital. I have no idea how it works, John, and let's just say that this is more than a prop today. So welcome back, ladies and gentlemen, and we now move to the panel session. And of course, as I earlier introduced, you know the panellists, or in this industry you should know them. We have, of course, the Chief Executive of the Financial Services Council, John Brogden. We have the Chairman of the AFA, Brad Fox. We have Simon Harris from Guardian Financial. We have Don Trapnell, who is Director of Synchron and who has something like 45 years' experience in the life office administration and management industry. And if Don doesn't know the industry by now, then I don't know who will. And we have Simon Swanson to our right, sitting beside John Brogden, and Simon is, of course, the CEO of Clearview, and he is formerly also of Commonsure and a number of other places, and he's going through a very interesting time at the moment, and I'm sure as a journalist he will welcome any questions I might have vis-a-vis the future of Clearview and the market offer that's been made, and why didn't I put my foot on some shares earlier, is my simple question. So that's just introducing the panel. And clearly they're coming from some very different directions on some of the issues, but as you heard from the discussion by John Brogden and Richard Clippen, there's also a developing an amount of common ground. So the reason we have these people on the panel is that we felt that that provided a balance in the argument. So I'm going to start things off with a question for the panel, and I'm going to probably throw it first to Don Trapnell, and that is this, that there's been a lot of discussion about the amount of churn going on in the industry, and I know that our friends at the regulator, ASIC, last week to Money Management gave us the news that they were concerned about churn, and then they had picked it up in their examinations, regular examinations of the industry. So, Don, if churn is such a big issue, how much of it's actually going on?
It's interesting you asked that question. ASIC has said that they were concerned about the level of churn. They got that view from their shadow shopping exercise. Now, shadow shopping exercise means asking sophisticated questions to unsophisticated public. The only real statistics on churning don't actually rest with the public, and they don't actually rest in lapse rates. The only real statistics of churning rests with the life insurance companies themselves. We actually conducted a study within our firm on how much churning there is. If you got a sample of 5% of the population, you'd consider that to be a fairly good sample to base any assumptions on. Synchron's had about 400 advisors go through its books in the last 14 years. That's about 5% of the insurance advisor population. In that time, we were able to identify one churner, and his career was adjusted accordingly. A mature book, very low renewals, very high new business. Big warning signs for any licensee. Now, if we can identify 0.25% of 1%, 0.25 I should say of 1% as a churning, and we are a fair sample for the industry, surely you don't need a sledgehammer to crack that 0.25 of 1% eggshell.
John Brogden?
Don's right. I mean, ultimately, the insurance industry has the best handle on if there is churning and where it's happening and what the trends are and how it's dealt with. All I can tell you is that my members, the insurance industry, are concerned enough about it to want us to deal with it. and there's no uniform figure that our members give us, but it's an issue for them.
Simon Swanson.
I thought you might get to me eventually, Mike, on this kind of question. I'd look at it this way. I think there's a high-quality, fact-free debate that goes on in this area. I think if you look at, say, direct insurance, you'll see lapse rates are actually higher in direct insurance, and that'll depend on the products that are sold. So in Clearview's direct portfolio, it's about 12% lapse rates. In other products like funeral plans, you may get to 25% lapse rates. And as John said earlier, the advice lapse rate is probably around 13–14%. Now that in itself is not a bad number. That doesn't necessarily indicate churn per se. What that does indicate is customers are not satisfied with the product. And you see in the industry today high increases in premiums. So some companies have got their premiums going up 20 or 30%. Now I think it's in the advisor's interest to actually look after their customers and try and get a good deal for it. Now that could happen in the first year, second year, 10th year of the policy. So I think there's a lot of fact-free debate that goes on around the issue. It is an important issue. At the end of the day, it's the quality of the sale that actually impacts the most on the persistency of any policy in the industry.
Simon Harris.
Good morning, Mike. Good morning, everyone. I think it's fantastic that this debate's out in the open, firstly. There's been talk about churn going on behind closed doors for years and years, and there's been a bit of a stigma over the whole industry. So at least the debate's out and in the open now. I agree wholeheartedly with John. The majority of advisors are professional, act in the best interests of their clients. There are legitimate lapses in our industry, and that's consumer-driven to the great extent. However, there needs to be a balance between sustainability and advisor remuneration. So I think this debate's very healthy.
Brad.
I guess where I start from on this, Mike, is what's the definition of churn? I mean, if it's about, if you're doing something that makes your client better off and it's in their best interests, don't think it is. If it's a lapse because of a claim being paid on death, I don't think that's churn. Pretty hard to rewrite that client. You know, we've really got to get the definition right about what churn is, and I think we've got to actually move past that. And John, you did mention right at the start of your presentation today that this whole debate got off on the wrong foot. It was portrayed as a debate around churn, where it's actually an issue around sustainability. So churn is part of the problem, and I think it needs to be addressed if there is a quantum of it, and we need the evidence, the stats that help portray how big a problem that actually is. So we're not cracking an eggshell with a hammer. But yeah, more than anything else, we actually need to get the bigger debate on the table, which is how sustainable is the actions going on in the marketplace, how much of that's an advisor issue, how much of that's a product provider issue, and at the end of it all, don't forget the client.
Before I move to the next question, I'll also say to our webcast watchers that if they refresh their browsers at this point, they're likely to see any of the questions and emails coming up that may interest them and persuade them that they too should ask a question. So I'm going to ask...
Do you know what that means, that stuff you just read out?
Not a bloody clue. Listen, I'm grey, you know, and that carries a certain burden. And just for that, Brogden, you said in your earlier answer that your members, the insurers, had a pretty good grip on, you know, churn factors. And if that's the case, if your members, in fact, do have all the details on churn, why aren't they outing the churners and naming and shaming them?
Well, I don't think it's in anyone's interest to name and shame them. What it is, though, and what my members tell me is where they identify clear churning activity, they will cease to deal with that person. Now, because it's such an open and competitive market, that person's got a whole lot of other people to go to continue that behaviour. But so that's the answer to that question. But Brad's right. If we just focus on churn, we get lost in a pretty dark corner and run around into each other all the time. I think the broader point we want to make is how sustainable effectively are the existing forms of remuneration, and what do people think about I mean, what I'd like is some feedback on what people think about options for remuneration, which is the direction the framework's going in.
Don Trapnell?
We can't ignore the fact that the churn was the original predicator of this entire debate. And to stand up in front of the people in this room and say, oh, we're sorry, we shouldn't have done that, you're ignoring the fact that you've made the accusation. And that's what has driven this debate from day one. I'd like a small experiment. Those people in this room who are actually advisors, put their knees underneath a Laminex table in someone's kitchen and put themselves in danger of making a sale. Could you please stand up for me, please? Okay. All of you, if you've put your knees under a Laminex table in the last 12 months and put yourself in danger of making a sale, if you have, in the last 12 months, spoken to a client and decided that the client's best interests were served, by moving that client from one company to another, stay standing. If you haven't, sit down. Okay, this debate says you're a churner. You're a churner. Now, is that a motive? Yes. Of course it's a motive. And this whole debate has been built around an incredibly emotive issue. Yes, it is about... Thanks a lot, guys. It is about sustainability. No question at all about that. But the whole thing was driven wrongly from the start. And it's okay to say, gosh, I'm sorry, we made a mistake. Omar Khayyam said, the moving finger writes and having writ moves on. Not all thy piety nor wit shall lure it back to cancel half a line, nor all thy tears wash out a single word of it. In other words, the word's out there, we've been accused of churning, we are sick and tired as advisors of being the only panacea for all the ills of our industry.
Yeah, well, Don, also, you know, he who has not sinned can cast the first stone, and if you haven't made a mistake, you can stand up and sit down and do whatever you bloody want. The reality is that we want to reframe the debate, so either get engaged or get emotional. You know, time to move on.
But it is an emotional subject, though.
Well, this is
and
business.
We'd like to be engaged,
this is business.
It's also an emotional subject.
Let's have a business discussion.
Simon Swanson, you're sitting there enjoying being on the periphery?
Oh, look, I just love being a spectator in this kind of stuff. It is so uplifting, to say the least. I think the facts are that there is little churn in the industry because people are genuinely looking after their clients. I think what the issue is, if you go back, we've got some spectacular things about to happen in the industry. It's losing about $100 million a quarter as an industry in income protection insurance. So believe me, you're going to see premium increases come through this industry like you haven't seen them before. That's going to have a significant impact on clients. It's going to have a significant impact on advisors. And to me, that's even a larger issue. But the most important one is actually looking after clients. And I think we've gone from a term and invest the difference one. And I think that's a mistake really in the first place. I think we should be on level premiums, etc., and that actually builds long-term a sustainable industry. I think the other point about this, the economics of this industry is not as it appears, particularly with respect to commission. The industry pays 115% up front and a 10% trail. The average length of policy is somewhere around 6 years, so you don't have to be a rocket scientist to work out. That's about 165% of total premium paid out as commission. If you do levels of 30% a year, that's 180. So from a pure life insurance company perspective, doing level premiums is actually more expensive, or level commissions, I should say.
Simon Harris, you're the Omar Khayyam of the industry. What's your view on it?
Firstly, clearly experience. Don's been in this industry for longer than I've been alive. Counts for something in the engagement with the crowd. So I don't propose to compete with Don on that level. But I will say that I'm pretty heartened by listening to John and talk about the engagement with the AFA and the FPA. I think it's fantastic. It means that we are having advisors' voice being heard, because we haven't had the advisors' voice heard often enough, and our advisors told us that when we surveyed them and put that in our first submission for the consultation period. But also, just taking a forward view, there will be changes to business models. There's no doubt about that. Have we hit the right mark at the moment? The advisors are telling us absolutely not, and I agree with that. I think there's some compromise to go to get that balance right between sustainability. But just looking forward to the opportunities in the future, we all know about underinsurance, but Scott gave us some fantastic statistics today about the amount of savings that people have got and that doubling down of looking after their risk, I guess, when times are uncertain. So I think we'll come out of this, there'll be a happy compromise. Our advisor remuneration must be looked after because they're the people that go out and sell these products that consumers need. And we know that people that have advisors get much better outcomes.
Brad Fox.
I think it's really important that our advisors do get a choice between different remuneration models. I mean, we're hearing that loud and clear in the feedback to us and through our working group on the issue. I guess having not been in the industry all that long myself, I can speak firsthand about when you start as an advisor in your own business without a book of clients. Now, I rode hybrids from day one because I had some good counsel around me that said that was the sustainable way to build a business. But there's others that are starting on upfronts and have started to build businesses on that model and probably need to continue that track for a period of time. So having a range of remuneration options helps a marketplace operate effectively, but I think we need to incentivise, or the product providers need to think to incentivise advisors to use models that they feel are more sustainable to them. And we're hearing from Simon that Level seems to fit their model. Hybrids probably suit others, and Level seems to be the one that's left off to the side. If you're a brand new advisor and you're starting out, you have enormous pressure to pay the bills, pay the mortgage, feed the family, run the car, see the clients, pay the phone bill. Can you do that without a Level commission? Can you do it with a Level commission that might be clawed back within 3 years? Gee, that's pretty hard to work on. Our members are telling us clearly 3 years doesn't work. 2 years, maybe does, maybe.
I just want to add something, Mike, in terms of my view where APRA's at, and Simon has the pleasure of having APRA come through the door, like all of my members do on a regular basis. But whilst, as Simon said, the economics are a bit misleading. You saw Richard's graph in that sense. The reality is APRA's waiting for that to happen. They think this is all going to end and something's going to go wrong. So that's hence the increase in capital standards, capital requirements. So APRA takes an incredibly pessimistic, and maybe that's the job of a prudential regulator. They take an incredibly pessimistic view of where we're going, and it's not in a negative sense, not in a pejorative sense, but they really are worried about how sustainable the industry is.
And I think that covers group insurance too.
Yes, it does.
So you're seeing increasing capital standards through LAGIC from the 1st of January in group insurance. The irony, of course, is group insurance gets rolled every 3 years, and that's capital guaranteed. And the issue of that is the cost of actually tendering in group insurance is now starting to drive up the costs of group insurance. And my concern in this whole discussion is actually around the cost of giving advice, because that is the core issue. And I think that cost is going to go up for the